Hey guys, so in today's video, I want to talk to you about how much money can you make as a private lender in Canada. And of course, as you know, the money you make depends on how much money you invest and the return rate you get. So in today's video, I will take a deeper delve into what kind of returns can you get in private lending. Now, before we jump into the video, I want to do a quick introduction. My name is Raghav. I'm the managing broker for Seven Lending, a brokerage which specializes with private lending. I work with a lot of private investors like yourself in helping them place their funds in private mortgages and trying my best to make sure you get a good, stable, healthy return on the money. Now, when it comes to private lending and investing in private mortgages, there are a lot of factors which come into place to govern the interest rate you can earn. And you have to know that in a lot of cases, it's not just the interest rate you make, but also the yield you get. But before we dive right into it, I just want to take a 101 step and tell you what is private lending. In a nutshell, private lending in our conversation is lending which is secured against real estate. I will take a bigger focus on the rates within BC and in major urban areas. You can use it as a benchmark for other places as well, but I hope this video gets into a good insight. So let's get started. So first, I want to talk about what are the main 5 factors which influence the return you can get on an investment in a private mortgages. Basically, these are 5 essential things you should look at before you determine interest rate or the yield on an investment you're about to make. Number 1 thing, location. Location is key. Typically, the more urban the place is, the less risky it is. So typically that leads to a lower yield versus if you do the same kind of financing in a rural area, because those properties would be tougher to take your money out from or sell in case of a loss. So location comes into a place. A specific example here is if you're financing a property in Vancouver versus a property in Prince George, all other factors remaining the same, Vancouver might be priced cheaper because those are considered safer, easier to get out of, easier to place versus a place like Prince George. Number 2, and this is one of the most important things, is the loan to value. Now, for those of you who don't know, loan to value is essentially a percentage of finance you have based on the property value. Now, just to take some simple numbers into place, if you have a property which is worth $1 million and you are, as a lender, are financing $500,000, you're financing 50% of the property value, and in common terms, we would call this 50% loan to value. Now, this is one of the most major number we look at when lending, because this is one of the simplest way to see how much risk you have, what is the exposure, and if it is considered safer or riskier. So that is really important that you look into it. And number 3 factor is the type of property. Firstly, whether it's residential, commercial, and if I have to go deeper, is it a strata property? Is it a warehouse? Is it an office space? Is it a standard detached home? Is it a mobile home? Is it a land-only file? Some of the properties carry with them inherent risks, and the return we calculate or how we price a file is dependent on the type of property. Number 4 is the position. Are you giving a first mortgage, a second mortgage, or third mortgage? Now, most individual lenders go out there and give second mortgages. So this also factors into the return you can get. Typically, as obvious it is, a first mortgage will be priced lower, a second mortgage will be priced higher, and if it's a third mortgage, it will be priced higher than the first 2. Factor number 4 is having a look at the overall scenario, exit, and the details of the file. In general, when I am lending money for some of my lenders, the things we would look into is, does their income, exit strategy, the reason why they're getting the money, their credit history make sense, are they behind on their payments, so on and so forth. And factor number 5, if you are doing a second mortgage or a third mortgage, where is this first mortgage from? Is it from a bank or a private lender? Because if it is from another private lender, that kind of shows the client or the borrower is already exposed to some risk and you are able to get a higher interest rate. So make sure you look into all 5 of these factors. And when you work with a mortgage broker like ourselves, who is helping you get your money out, we will review all of these and advise rate. But these are the key things we somehow look at to determine the kind of interest rate you can get. Now, moving on to the next part is, how do we price deals? Well, Assuming borrowers are good, assuming it's a standard detached property in an urban area, let's do a case study. So a borrower comes to us and they have a property in Surrey, let's say a detached home worth $1 million, and it is located right in Surrey. So the location is good, we're confident about it, and it has been independently appraised. Now, first, I will look into the returns you can get as a first mortgage holder. Now, they come to us and look for something around 400,000 as a first mortgage on $1 million valuation. This would be 40% loan to value. So typically between 0 to 50% loan to value on a first mortgage. Right now, as of November 2024, the interest rates we're seeing are between 8.5 to 9.5% return to the investor. Now, one other things which I missed earlier, but you should be careful of, is a lot of times as a private lender, you might be able to get a portion of the lender fee. Sometimes it could be 0.5%, sometimes it could be 1%, but it will depend on the overall risk of the file and the overall situation. But the typical interest rate you'll charge if it's below 50% on a first mortgage will be between 8.5 to 9.5. If you're doing a first mortgage up to 65% of the value. So if it's $1 million property, if you are lending up to 650,000, 65% I would consider as a moderate exposure. You can get rates between somewhere in the 9% to maybe early 10, depending on the property and location. Now, if you are going up to 75% as a first mortgage lender, the rates you will get will be somewhere in the high 9s to the mid 10s to high 10s, depending on the overall scenario. Now, I will go on and give you some examples later. Now, moving on from first mortgages, you also want to look at second mortgages. Now, second mortgages, if done right, could be a much better tool, especially if you have smaller amount of funds available, because a lot of the clients who come for second mortgages might look for 100, 150, 200,000 versus a first mortgage which may end up being higher. But because it's in second position, you do get a higher rate on your investment. So coming back to the previous example, if you're doing a second mortgage less than 50% of loan to value. So in our example, let's say a homeowner comes to us, they have a property worth $1 million, they have a bank mortgage for 200,000, and they're looking for 100,000 to clear up their debts and use it to invest in their business. If you add 200 to 100,000, that's 300,000. That's roughly 30% loan to value. So still below 50%. A typical rate on something like this would be between 9.5 to 10.5 as a second mortgage lender. And in some cases, you may get 0.5 or 1% added as a fee, bringing your yield up to 10.5 to 11.5. Now, if you were to do a second mortgage between 50 to 65%, the return you can get is anywhere between 11.5 to high 12s, depending on various circumstances. And if you are doing a second mortgage between 65 to 75%, you can expect returns, including a fee, between 11.99 to 13.5, 13.99, depending on the overall strength, details, and various factors of the file. So now that you have a rough idea, I will look at a case study to give you examples of the kind of returns we're giving to our investor. So a borrower just came to us who owned a condo free and clear in Vancouver. Now this property was free and clear. It was an older condo, but they had no active loans or liens on their property. The borrower did lose their job, but was planning to find a new job and hopefully get back on his feet in the next 6 months. And if that didn't work out, he was okay selling the property. He was only looking for 50 to 60,000 as a first mortgage. We were able to do that with minimal risk for our investors and get them a return of a 9.5 rate with a 1% fee. So getting their yield to 10.5%. This term was a 1-year term. It was open after 6 months. If the borrowers paid before 6 months, they had to pay the lender an interest penalty. If they paid out after the first 6 months, then it was open for prepayment. But this got the lenders a good 10.5% on a really safe property in Vancouver. And even if we factored in various risks, the lender was super comfortable with the risk and the reward here. So that was a property we did. On the other side, we just did a second mortgage for another one of our investors. So this was a rental property one of our clients owned in Surrey. It was worth about 1.5 million, which was confirmed through an independent appraisal. They had a first mortgage with a traditional bank, which was about 700,000, and they were looking for 100,000, 100 or 120,000 as a second mortgage, and we were able to secure our investor a rate of 10.95 plus a 1% fee, bringing their return to approximately 12%. Now, these borrowers did have a solid exit strategy, and we looked into their credit, their history of paying their existing mortgage, so on and so forth. So that is how we come up with pricing, and those are some examples. But one caution you have to make sure is, as rates change in the market, there's a lot of lenders out there, so that the interest rates are changing constantly. And as I'm making this video, we do expect another rate fall in December, so that may or may not affect the rough rates I gave you. Now, as an investor, you have to make sure the other factors which affect your yield. The other factors include, of course, one is the lender fee. Second, is the term open or closed? If it's a closed term and the borrowers are planning to get out, you do get an access to an interest penalty, or look at various things. The third thing is, not that I hope you ever have to use it, but what are the charges for NSF, missed payments, things like that? How much is the penalty for that? You want to make sure your basics are covered. So I hope this video was helpful for you. I'm trying to do more and more video on private lending investments, but if you are someone out there who is on the fence or wants to know how to get his money out, or how to get her money out and make good returns on secured on real estate, give us a call, or make sure you click on the link in the description, go onto our website and fill in the form, and we will contact you and make sure I'm here to answer your questions. So if you like this content, make sure you like, subscribe, and do leave us a comment. And I do hope you found this helpful. So have a great day.